Welcome to Chapter 22, where we will be discussing and learning about statement of cash flows. Our first learning objective is to understand cash and cash equivalents, as well as the business importance of cash flows, and describe the purpose and uses of the cash flow statement. A lack of cash flow is crucial to every company. Cash flow can be one of the main causes of bankruptcy. A sign of a healthy company is positive cash flow from operations. Companies need to expand, issue dividends, and maintain solvency during economic downturns. So over the years, the statement of cash flows has grown in significance, and many consider it to be less susceptible to earnings management or accruals or reversing different things like that, and to give a better picture of success. Because the cash flow statement is a fact. It's cash coming in, cash going out. There's not a lot of judgment involved in the preparation of the statement. The statement of cash flows is used to assess the quality of earnings, a company's ability to repay debts as they become due, and a general sense of the company's long-term viability. The primary purpose of the statement of cash flows is to provide information about cash inflows and outflows. And we group all the inflows and outflows into operating, investing, and financing activities. So it gives a really good picture of what the company's cash has been up to during the period. The statement reports cash receipts and payments and the net change in cash. And the net change in cash needs to reconcile to the change in cash on our statement of financial position, which is an interesting situation because you will automatically know if your statement of cash flows is correct or not. The information in a statement of cash flows enables users to assess the liquidity and solvency of an entity, the amount, timing, and uncertainty of future cash flows, because you can compare cash flow statements between different years, the reasons for the difference between net income and cash flow from operations, and it gives the user an opportunity to make an assessment about the organization's representational faithfulness. You can really get a sense of what the impact of accounting judgments are on the financial statements. Cash flows are defined in terms of inflows and outflows of cash and cash equivalents. So cash is defined as cash on hand and demand deposits. So cash equivalents are short-term, highly liquid investments, readily convertible into known amounts of cash with insignificant risk of change in value. So bank overdrafts are included in cash to cash equivalents under IFRS and ASPE if they are part of the company's overall cash management policy. And under IFRS, preferred shares acquired close to the maturity date could also possibly be included in cash and cash equivalents. Learning objective number 2, identify the major classifications of cash flows and explain the significance of each classification. The statement of cash flows is called a cash flow statement under ASPE. It classifies cash receipts and payments into operating, investing, or financing. And it's usually based on an overall analysis of the changes in the account in the statement of financial position over the accounting period. So you're going to have operating cash flows related to working capital accounts, current asset and current liabilities, investing cash flows, those involve long-term assets, and financing cash flows, which are derived mainly from changes in long-term liability and equity accounts. Okay, so operating activities. What are operating activities? These are principal revenue producing activities. They involve cash transactions that determine net income, such as cash inflows from customers, cash outflows to pay for operating expenses, employees, and surplus cash from operations is needed for paying dividends, taking advantage of new investment opportunities, providing internal financing for growth, and meeting obligations when they become due. So operating activities are really the bulk of the business's activities, their core business. Investing activities involve the acquisition and disposal of long-term assets and other investments. So investing cash flows arise from loan activity, acquiring and disposing of investments in PP&E, intangibles, and derivatives. The use of cash in investing activities tells readers if the entity is reinvesting in additional assets that will generate profit, or whether long-term productive assets are being sold and converted into cash or bought. Financing activities, so these result in changes in the size and composition of the entity's capital and borrowings. So in this section, we're going to be looking for changes in equity. Details of financing cash flows allows readers to assess the potential for future claims against the organization's cash and identify major changes in forms of financing, especially between debt and equity. So financing activities invest the company's capital structure, which in turn affect the requirements for future cash flow. So there are a few differences. The good news is that for statement of cash flows, IFRS and ASPE are almost converged. There's not a lot of differences. You call this statement of cash flows over here, you call it a cash flow statement, no big deal. But there's one classification difference that's important to note. So under ASPE, it's for interest and dividends paid and interest and dividends received. So under ASPE, ASPE is actually stricter than IFRS in this regard, which is surprising because as we know from the rest of this course, IFRS is normally more strict than ASPE. But here is where ASPE lays down the law. So ASPE says, listen, if you have interest or dividends that you're paying, so you're paying out interest on a loan or you're paying dividends, then those are operating if it's recognized in net income. And if it's going through retained earnings, then it's a financing activity. And IFRS says it can be operating or financing. It's up to the entity to decide on their accounting policy. So IFRS says operating or financing, and ASPE says it must be operating if it's in net income, and it must be financing if it went through retained earnings. Same thing for interest and dividends. ASPE says that interest and dividends received. So if we're getting interest on an investment, or if we are receiving dividends from another company, ASPE says it has to go through operating cash flows, but IFRS says it can go through operating or investing. And this comes up a few times in the tutorial section, so it's just something that you really want to note. A lot of the times you'll be asked, how would the cash flow statement be different under ASPE? And the answer is, well, under ASPE, you would have to have recognized the dividends, the interest and dividends paid in net income if it went through net income, or as operating if it went through net income, and as financing if it went through retained earnings, whereas IFRS allows a company to decide. Classification of cash flows. So there are exceptions. So the sale of PP&E is a financing activity. So the gain or loss is excluded from operating because gain or loss is an accounting concept. It's not a cash flow concept. And the sale of PP&E is a financing activity. The payment of debt is a financing activity. And the outflows to purchase investments or loans are operating activities. And income tax payments are normally classified as operating. Some significant investing or financing transactions are excluded if they don't include cash. So if you're told in a example that the company bought equipment with shares, that's a non-cash transaction. They're swapping two different things. They're not exchanging cash. So that wouldn't go through a cash flow statement, but we would need to disclose that in a supplemental section of non-cash items. Learning objective number 3, prepare the operating activities section of a statement of cash flows using the direct versus the indirect method. So like we've said multiple times, there's 3 activities on a cash flow statement: operating, investing, and financing. And these guide the general format of our statement. Usually operating activities are listed first, followed by investing, and then financing. Individual inflows and outflows are reported separately. They're not netted. The statement needs to be presented on a gross basis. The statement provides a reconciliation of the beginning and ending cash balances as reported in the comparative statement of financial position. And as we said in this learning objective, there's 2 different ways you can create a cash flow statement. There's the indirect method, and what the indirect method does is it presents net cash flow from operating activities by taking net income. Net income is an accounting concept, so it's an accrual base, and then it reconciles back what would be needed to convert net income to a cash basis, and then that provides you your cash flow from operating activities. And the direct method takes a different approach. It doesn't care about net income. It doesn't start with an accrual basis and then reconcile back to a cash basis. It simply says, what did you get through your bank account? What did you pay to your suppliers? what did you pay what did you get in from your customers, and it just looks at cash receipts that way. From a practical perspective, the direct method requires us to do quite a bit more problem solving to get those answers in terms of those cash flows, whereas in the indirect method, we use the statement of financial position as our guide. So the following is an example of a statement of cash flows prepared using the indirect method. How do we know this is the indirect method? You can see net income is the second line from the top there. If you have net income on your statement of cash flows, it is an indirect method. And you can see that we start out with the cash flows from operating activities. We've got net income. We're going to add back some items, get our net cash provided by or used in. So depending on if that's a positive total cash provided by operating activities or a negative, we would change it to say net cash provided by if it was positive. And if it was a negative total, we would say net cash used in operating activities. And that's similar for each of the sections below. You can see that we start with operating activities. Then we have investing activities. Then we have financing activities. And then at the bottom of the cash flow statement, we show the net increase or decrease in cash. And that is a formula running through the subtotals of our statement. So what amounts have we shown on our statement as the net increase or decrease in cash? Then the next two lines there, cash beginning of period and cash end of period, those are amounts we're going to take right off of our statement of financial position. And ultimately, the change in those two accounts that you're taking off your statement of financial position need to reconcile to that top line, the net increase or decrease in cash from your cash flow statement. And that's how you know you've picked everything up correctly. It's also worth noting here in the green box how we set up our cash flow statement. So to set up a statement in proper form, we're just going to list out the company name, statement of cash flows, and the period covered. So for instance, year ending December 31st, 2020. When preparing a statement of cash flows using the direct method, the operating activities section is the only one that differs from the indirect method, which is great. So investing and financing activities are exactly the same between the direct and the indirect method. So sometimes in the tutorial section, you'll see we need to prepare an indirect cash flow and then also a direct cash flow for the same question. And the only thing that would differ between those two methods is the operating activity section. However, you have to come to the same answer. So regardless of how you go about creating your cash flow statement, the net cash provided by or used in operating activities has to be exactly the same. An example of a cash flow from operating activities prepared using the direct method is below. And you can see you don't see net income here. We don't start with net income in the direct method. So we've got cash receipts from customers, cash payments to suppliers for goods and services, cash payments to and on behalf of employees, cash payments for income taxes, and net cash provided by or used in operating activities. And again, we would change whether we're going to say provided by or used in, depending on if that total is positive or not. The format of the statement. So both IFRS and ASPE encourage but don't require the use of the direct method. So the standard setters do favor the direct method, and there's even some rumors that possibly the direct method will be mandated at some point in the future, especially by the IASB, but no one knows for sure. Right now, either the direct method or the indirect method are completely acceptable. Why does the IASB favor the direct method? Well, because it's more consistent with the objective of providing information that's useful in estimating operating cash flows. And the information about cash receipts and payment can be more useful than just looking at the changes in the statement of financial position accounts. And the incremental cost of accumulating the data, which is what a lot of companies have complained about, they're saying it's not significant, given companies have more sophisticated accounting systems. I think it depends on the company. Okay, so use of the direct method is the exception. So indirect method is actually the most popular. So most companies are using the net income and reconciliation approach, even though the standard setters like the direct method better. The indirect method is favored by companies because it focuses on the difference between net income and cash. It's less costly to develop, and it adjusts from income to cash flows. And reporting the income statement on a cash basis rather than the accrual basis might suggest net cash flow is as good as or better than net income as a performance measure. So preparing the statement on a completely different basis, companies may be worried that it's going to be used more so than their income statement to evaluate their performance. Learning objective number 4, understand the basic steps in the manual preparation of a cash flow statement. The information to prepare the statement comes from 3 sources. So we need a comparative statement of financial position. We're going to have the current income statement, and we're going to need selected transactional data. There are 4 steps in preparing the statement of cash flows. So the first thing is we're going to determine the change in cash and cash equivalents using the comparative statement of financial position. We actually kind of disregard that. I actually think that's the last step. We record information from the income statement onto the operating activities section under 3 categories. So category 1 are amounts that are reported as revenues and expenses that are not the same as cash received and paid, costs that were incurred and paid for a previous period, or amounts that were reported as gains or losses in the income statement where the underlying activity is not operating. Then we're going to analyze the change in each statement of financial position account, identify all cash flows associated with the changes in the account balance, and record the effect on the statement of cash flows. Then we're going to complete the statement of cash flows, calculate subtotals for the operating, investing, and financing categories, and ensure that the net change in cash you determined is equal to the actual change in cash for the period. So cash flow statements are complicated, and I will do my best to walk you through, and we'll go through quite a few examples in the tutorial section. But there are some really great resources out there that I want to let you know about. So one of my favorite resources is called Accounting Stuff, and they have a cash flow statement mini-series. And I watched this mini-series, and I think it does a great job of kind of summing up and explaining cash flow statements. So I suggest, in addition to watching the lecture, usually I'm not as keen on lectures as I am on tutorial sessions, but in this case, I think the cash flow and the cash flow lecture and the cash flow tutorial section are both really important because there's a lot of theory around cash flows. So I highly suggest that you click on the links and watch these videos. I've also included 2 Wiley Plus videos down below. You may have trouble accessing these if you're not taking a Wiley Plus course and you don't have access to the additional Wiley Plus materials. So those ones may or may not work for you. But the first one is going to include 3 different videos, and they're relatively short. It's not a huge time commitment, but I highly suggest that you watch them. For the students in my class, I will post these on my D2L website, these links, because of course I know you can't click on them in this video, and I will post them underneath my YouTube channel as well. Learning objective number 5, prepare a statement of cash flows using the direct method. Preparation of a statement of cash flows. So here's an example. Tax Consultants, Inc. began operations on January 1st, 2019, and they issued 20,000 common shares for $20,000. Office space and furniture and equipment were rented. Following are the comparative statements of financial position and an income statement for 2020. An examination of selected data shows that a dividend of $14,000 was declared during the year. So we can see we've got an income statement, and we've got the comparative financial position. So we've been given the December 31st, 2019 balances and the December 31st, 2020. And the question was kind enough to run the change, the increase or the decrease in the account beside the 2 comparative financial positions. That's going to be helpful. Okay, so let's go through our steps. So first, we're going to determine the change in cash. And so we're just going to take this right off of the statement of financial position. So we had cash of $89,000 at December 31st, 2020. The opening balance was $40,000. So our cash increased by $49,000. So that's what we need our cash flow statement to reconcile back to. Next, we're going to record information from the income statement onto the statement of cash flows. So we're going to have cash received from customers, cash paid to suppliers, and income taxes paid. So if we look back here, we're going to have from the statement of, yeah. So we're gonna have revenue, operating expenses, and income tax. And we've turned that into cash received from customers, cash paid to suppliers, and income tax paid. So we just turned revenue into cash received from customers. Operating expenses, we turned it into cash paid to suppliers, and income taxes paid are the same. And now, question for you, what type of cash flow statement are we preparing here? Is this the direct method or indirect? Well, I suppose the title gives it away. It does say direct method, but yes, of course, it's the direct method. And the reason that we know that also, aside from the title, is that we're not starting with net income. We're simply saying what cash did we get in and what cash did we pay out. So we're not taking an accrual basis number like net income and adjusting it backwards. We're simply starting at the beginning and saying, what did we get in and what did we pay out? That's direct. And they're using a cash flow worksheet here, which you absolutely can do. There is a tutorial in the appendix on cash flow worksheets. In the tutorial section, we did not use cash flow worksheets, and you don't need to use them. You can absolutely solve all the questions without. This is a good illustration of how to use a cash flow worksheet where you're really bringing the numbers in and then you have adjustments running through the middle. So step number 3, identify all cash flows associated with changes in the statement of financial position account balances and record the effect on the statement of cash flows. So you can see we took those numbers right off of the income statement, and now we're going to adjust them for changes in the statement of financial position. So we've taken our income statement numbers, and now we're going to say, well, what does the statement of financial position tell us about those same type of transactions? So for instance, AR. So our accounts receivable increased by $36,000. So let's go back and take a look at that. So right here, we can see that accounts receivable went from $30,000 at December 31st, 2019 to $66,000 at December 31st, 2020. So it went up by $36,000. Now, is this going to increase or decrease our cash received from customers? Well, think about it. When the more AR that we grant, the more people we say, oh, don't pay us now, pay us later, then the less cash we're going to get in from customers. So we're going to deduct an increase in AR from our cash received from customers. If AR had gone down, then we would have gotten extra cash because people were paying us and we were granting less credit, then we would have added it. But because it's a decrease, but because it is an increase, we are going to deduct it. So we can see here, you can see in the top line, we've got our cash received from customers, 125,000. That came right off of our income statement. And we're going to reduce it by our increase in AR. That gives our cash flow number 89,000 for cash received from customers and cash paid to suppliers. So those are our operating expenses right off of our statement, right off of our income statement. And now we're going to adjust it by our accounts payable. So let's go back. So accounts payable, what happened with that? Well, our accounts payable was 30,000 and now it's 35,000. So what that means is that our accounts payable increased. We want our accounts payable to increase because it means the less we pay, the more cash we have. But don't forget, cash paid to suppliers is a cash outflow. So saving cash actually reduces the cash outflow. So we're going to deduct it from the cash outflow. Okay, so we're deducting it. You can see our 85 is negative, so we're deducting that 5, or we're adding it the opposite way because it's an increase. So now our negative cash outflow is 80,000. And income taxes paid are exactly like they were on this income statement. So here you can see income tax expense was 6,000. So we've just turned that into income taxes paid. So we always relabel these items as cash flow activities. So you can see sales revenue and AR together became cash received from customers. Operating expenses and AP became cash paid to suppliers, and income taxes expense became income taxes paid. So that completes our operating activities section. So you can see that our net cash flow from operating activities is $3,000. Then we've got our cash flows from investing activities, and we don't have any investing activities. So actually, let's talk about operating activities just for a second. So operating activities are always going to pick up all of your current assets and your current liabilities. So even if you're doing the direct method, you still need to cover off the changes in all those accounts. So here we can see we had cash. We're kind of going to deal with that later because that's the bottom of our cash flow. AR is a current asset. We dealt with that. We just talked about how we flowed that through the cash received from customers. Accounts payable, we dealt with that through our cash paid to suppliers. And now we only have 2 equity accounts left. So there's no long-term assets like PP&E. So we didn't have any investing activities. You can see how that section's blank. But we do have some cash flows from financing activities. So in the supplemental information, we were told that right here, it said, they issued 20,000 common shares for $20,000 and that a dividend of 14,000 was declared during the year. So we've got 2 equity transactions that we were actually told right there. So we've got the proceeds from the issue of shares. So we're going to have 80,000 minus 20,000, which is going to be 60,000. Where did we get the 80 and the 20? Well, you can see our common share account. It increased by $60,000. It was only 20,000 and now it's 80,000. So we increased that. So we have a cash outflow there for 60,000. And then the dividends paid, which is what we were given, we're deducting that as a financing activity as well. So we're deducting that 14,000. So we've got cash provided by financing activities is 46,000. So our net increase in cash, we're just going to add together the 3,000 from operating and the 46,000 from financing. And we're going to get a net increase of cash of 49,000. Now, does this reconcile back the 49,000? Does that reconcile back to how much cash actually changed on the statement of financial position? Let's take a look. Look at that top line there. Cash changed a $49,000 increase. So we did get the right answer. That's how we know, because that subtotal of our cash flow statement was 49, and that needs to be the exact change in cash on our statement of financial position. Okay, so step number 4 is going to be to complete the statement of cash flow. So we've just fancied it up a bit, and you can see it's all the same numbers that we already had. All right, so I also have one more link here, which is a Wiley Plus link, and this is a walkthrough of another cash flow statement for preparing cash from operating activities. So I will put this link up as well. Learning objective number 6, prepare a statement of cash flows using the indirect method. So the method we just did was the direct method. So we didn't care about net income. We were just looking for those cash flows. And here we're going to use the indirect method. So here's our example. Eastern Window Products Limited has been operating for several years. The company obtained a mortgage of $155,000 to help finance the acquisition of some land and building during 2020. Assume that EWPL is a publicly accountable enterprise and company management has chosen to present interest paid as an operating cash flow and dividends paid as a financing cash flow. So here we're given a comparative statement of financial position, and then here we have our income statement. Definitely a lot more accounts going on than in the example we just saw, but they've still run the change through, which is really handy. So the first thing we're going to do is determine the change in cash, and this is what our cash flow statement needs to reconcile to. These amounts are right off of the statement of financial position. So cash decreased by 22,000. Step number 2 is going to be record information from the income statement onto the statement of cash flows. Under the indirect method, we're going to record net income in the operating section. So we're going to say cash flows from operating activities, and we're going to have net income 59,900, and that's coming straight from here. You can see that net income there is 59,900. And that's the starting point for our indirect cash flow. Then we're going to identify all cash flows associated with changes in the statement of financial position account balances and recognize the effect on the statement of cash flow. So what we're doing here is we're looking through all the changes in current assets and current liabilities. So we need to make sure we've hit all current assets, all current liabilities, and if there's an increase or a decrease, we really need to think about if it's saving us cash or if it's costing us cash, if there's an increase or a decrease in the account. And so the signs can be a bit tricky, but we need to pick up all those changes. And normally we also look on the income statement and pick up anything there, that is non-cash. Like normally you'd be able to find depreciation expense, which I can see there, and we'll add that back as well. But first, let's get started by going through the changes in the statement of financial position. So we've got, let's go back here. So we've got accounts receivable decreased by 10,000. So a decrease is good. It means we've lent less credit. So that's going to be a cash inflow from operating activities. So we're going to add 10,000 back. You can see that there. Our next current asset is going to be inventory. So you can see our inventory decreased by $9,000. A decrease and our inventory increased. So an increase in inventory means we must have used cash to buy that inventory. So that's going to be a negative cash or a cash outflow in our operating activities. So we're going to subtract 9,000, and you can see that there in B. Next, we've got, what's our next current asset? We've got prepaid expenses. So prepaid expenses decreased by $1,500. So a decrease in prepaid expenses means we must have paid out less cash for that. So that's going to be a cash inflow. So we're going to add back $1,500, and you can see that there in C. Next, we're going to add back anything that's not cash on the income statement. So, and sometimes we do this first before we start going through the statement of financial position, but it really doesn't matter what order you do it in as long as you pick up everything. So we're going to go onto the income statement and we're going to look for depreciation expense. So here I can see that there's depreciation expense going through the income statement of $15,000. And we're going to add that back to our cash flow statement. So you can see 9,000 and 6,000 is 15,000. That's going to be our add back for depreciation. And then our increase in accounts payable, let's see how we got that. So now we've gone through all the current assets. So you can see that the next account after prepaid expenses is land. Land is not current, so that's not going to be part of our operating cash flow. So we can move on then to the liabilities. So accounts payable, it increased by 10,900. The more accounts payable we accumulate, the less cash we pay out because we're being like, we'll pay you later, we'll pay you later. So that means that this 10,900 is going to be a cash inflow. So we're going to add it, and you can see that there's H. And what do we have next? So then we've got income taxes payable. That increased by 3,000. Same concept as AP. We're going to add that back. So you can see that in I. And then we've got salaries and wages payable. That decreased by 7,000. We're going to add that back. And then you can see after salaries and wages payable, we hit mortgage payable, which is not current. So we will deal with that in another section. So this gives us our subtotal now for cash flow from operating activities. And you can see it's positive. So our subtotal will be called cash flow provided by operating activities. Number 3 is going to be our investing activities. So we need to figure out what's going on with PP&E and equipment. So let's see what we've got here. So we were told that the company obtained a mortgage to help finance the acquisition of land. Is there anything on here? So you can see that our buildings account went up by $200,000. So we must have purchased a building for $200,000. Let's see here, for $200,000, purchase of building. So the purchase of the land and the building and the mortgage. So we're going to have the $270,000. So here's where how we get the amount that we're adding back here. So you can see we're adding back cash flows from operating activities, and the purchase of equipment is $275,000 for our investing activities. And here is where we got that amount. So we said the purchase of the land and the building was $270,000. And we got that amount because we went back here and we said the building was $200,000, and then the land above it was $70,000. So the total of the land and the building was $270,000. And we can also see that our equipment went up by $5,000. So we must have purchased equipment for that. And what's the change in our accumulated depreciation account? it's $9,000. And in the accumulated depreciation buildings, we had 6,000. So 9,000 plus 6,000 is going to give me the 15,000 that I saw in my income statement. So I know that there's nothing that's come out of accumulated depreciation that would cause me to think that any assets have been sold. So what I'm expecting to see here is a $270,000 purchase of land and buildings and a $5,000 purchase of equipment. And that's exactly what we do have. So our total cash flows from investing activities are going to be $275,000. Now we're moving on. So those are all of our long-term assets. Now we're going to move on to our financing activities, which are like mortgages, bonds, or equity. So we've got a mortgage payable. We were told that the company received a mortgage for $155,000 in the question. So we're going to have that as a cash inflow. We should also be able to see that on the income statement. Yes. So we can see mortgage payable is $152,400. Okay. So we must have repaid then $2,600 of the mortgage because we got in 155, but we only have 160, whatever it was, 52,400 on our statement of financial position. So we must have repaid the difference. Then a bond issued. So let's take a look at where we got that from. So we've got bonds payable. So the bonds payable increased by 10,000. So we must have issued a bond to our investors because we have a bond payable to them now of 10,000. So that's our 8,000 there. And then dividends paid. How did we get the dividends paid number? Well, you can see that our common shares went up by 8,000 and our retained earnings went up by 51,900. I think in the beginning of the question as well, we were told, let me just see here. Okay, so dividends paid, we need to reconcile through retained earnings. So let's find that in our working notes here. Where are we here? Dividends paid. So retained earnings increased by 51,900, of which 59,900 was net income. So basically what we do is we say, and this is a really important step in cash flows, you always want to check retained earnings because you're rarely ever told what's going on in retained earnings, but you need to, that's one thing that you're fully expected to deduce. You're going to be expected to deduce a lot more, as you'll see in the tutorial section, but retained earnings in particular, it's not that difficult because there's not, all that really goes through retained earnings is net income and dividends. So what we're going to do here is say, okay, well, our retained earnings in December 2019 was 73,700 plus our net income, which was, where is it? 59,900 should equal, the December 2020 balance we're given, 125,600. And if it doesn't, that difference has to be dividends. And in this question, that difference was dividends. And we found out that it was dividends of $8,000 that were paid. Remember that dividends, when they're declared, they go through retained earnings. And when they're paid, they're going to go through dividends payable. So sometimes you need to look at the difference between those two accounts. But if there's no dividend payable account, then you can just assume that the dividends that have gone through retained earnings are paid. So our net cash from operating activities is 162,400. Okay, and now we're going to complete our statement of cash flows. So you can see we've just fancied it up a little bit. You can see, as we know, we're using the indirect method. So we've got our net income there. Then we're going to add back non-cash expenses and changes in working capital. The headings aren't crucial here. You have to have the heading cash provided by operations and then cash provided or used by operations, etc. But the part where it says net income and then add back, as long as you said net income and then adjust to cash basis for operating activities or something like that, that's fine. So we can see each of the different sections there. And then you can see at the very bottom of the statement how we have the decrease in cash. And that's simply the sum of our subtotals through our cash flow statement. And then we pull in the cash at the beginning of the year and the end of the year straight from the statement of financial position. And the difference between those has to reconcile. And here it does, because we know that our statement of financial position showed us a decrease of 22,000. Okay, objective number 7, prepare a more complex statement of cash flows using both the direct and indirect method. Okay. Another example. So Yoshi Corporation is a publicly accountable entity. The information needed to prepare a statement of cash flows is extensive. So this analysis of the changes in account shows only partial information. And okay, so we don't need to worry about that. So here we go, fair value net income investments were sold during the year for $32,300. Additional investments were also accounted for at fair value net income, were acquired at a cost of $26,000 and were still held at the end of the year. So that's some supplemental information. We've got some sales written off. So we've got our increased receipts from customers, our accrued liabilities, bonds payable, income tax, prepaid expenses. I'm just going to flip through this example because I don't think we've been given all the information that we need here, and it's not reasonable for us to reference the text right now. So cash provided or used by operations, you can see that we've got cash received from customers, dividends received on significant influence investments. So if those are part of the regular operations of the company, they're going to go through operating cash flow. Payments to suppliers, payments to and on behalf of employees, payments for interest and dividends on preferred shares, and income taxes paid. So you can see how it's the direct method because we're drawing a direct line to the cash flows. We're not using net income and working backwards. Then we've got investing activity. So we're going to have development costs. So let's take a look here. So during 2020, Yoshi incurred $200,000 of development costs that met the criteria for deferral as an intangible asset. So this account on the statement of financial position increased by $49,500. And land in the amount of $54,000 was purchased by issuing term preferred shares. So that's a non-cash transaction. We bought land for shares. And from the income statement, we have a gain on land of $10,500. And gains or losses on our income statement are non-cash items. That's an accounting concept, not a cash concept. So you can see here from a cash flow statement, we've got the land purchase, which is a non-cash transaction. It didn't hit our cash flow. You can see we have a blank in the cash flow column there. We've got the sale of land, which is $4,500 because it's $5,400. 54 minus the $10,500 must have been the proceeds that we got because what we're interested in the cash. So we sold $54,000 worth of land and we generated a loss of $10,500. So 54,000 minus 10,500 is going to give us a loss on this. It's going to give us proceeds on the sale of the land of 4,500. And then the gain on the sale of land is going to be 10,500. Okay, the following pertain to investing activity. So we had equipment and accumulated depreciation. And we can see the change in each of those accounts. Equipment costing 28,000 was sold at a loss of 1,500. And accumulated depreciation was 13,500. Therefore, the book value was 14,500. So we know that the equipment was sold at a loss. So the proceeds must have been our 13,000 minus our 14,500 minus the $1,500 loss. So you can see the proceeds on the sale of equipment there are 13,000. And the purchase of the equipment is going to be $73,000. Okay, so here's our cash provided by investing activities and financing activities. So we've got term preferred shares. Land in the amount of $54,000 was purchased by issuing term preferred shares, but that's a non-cash transaction. So assuming that the shares issued in the amount of $54,000 for the land, then the remaining $6,000 must have been paid in cash. So you can see our reconciliation of our common share of our common share account there. And then we've got our financing activities. So we've got our change in retained earnings. We've got our stock dividends, our net income there, which we're reconciling, and our cash dividends paid. So here's our cash provided by our used in financing activities. We've got our proceeds on the issuance of common shares, the proceeds on the issuance of term preferred shares, the repurchase and cancellation of common shares, and dividends paid on common shares. And there is another link where we can where this is walked through in more detail. I know I only covered parts of this example, but I will post this link for you and you can look at it at your leisure. And that concludes the first part of the Chapter 22 tutorial. And please join me in the tutorial section. For the lecture, sorry, that concludes the lecture. Please join me in the tutorial section, and we're gonna walk through a whole bunch more cash flow statements. By the time you go through those, I'm sure you'll be more comfortable with the concept of how to prepare both a direct and an indirect cash flow statement.